Good afternoon, ladies and gentlemen, and welcome to this earnings call by EQUATE Petrochemical Company. I am the call's moderator. My name is Fawaz Al-Sirri, and today I'm joined by today's speakers, Mr. Mohammed Hussein, EQUATE's President and CEO, and Mr. Ramesh Ramachandran, the Senior Vice President at EQUATE, and Mr. Sano Sermchai-Wong, the CFO. This call is held to share and discuss EQUATE's results for the year 2016, and this webcast is held live and is being recorded for future reference by accessing the same link. The format of the call will be as follows. The speakers will go through their respective slides, after which a Q&A session will take place. We expect the entire call, including the Q&A session, to last between 30 and 45 minutes. To participate in the Q&A session, all you have to do is look for a tab on your screen right now that reads Ask a Question, and I'll give you a second to locate it. I hope you've seen it by now. Now to ask a question, all you have to do is type it in at any point during the presentation, starting from right now. And I will then attend to your question during the dedicated Q&A session. Now, before I hand over the call to the President and CEO, I would like to remind you that the content of this presentation is for information only. It is intended solely for your own and personal reference. Such information is subject to change without notice, and its accuracy is not guaranteed, and it may not contain all material information concerning the EQUATE Group. We do not make any representation regarding and assume no responsibility or liability for the accuracy or completeness of or any errors or omissions in any information obtained herein. For our full disclaimer, please review the available slide on slide 2 of this presentation. And I will now hand over the call to the President and CEO. Mr. Hussein, please start.
Thank you, Fawaz. It's a pleasure to have you all with us in this call today. I may say good morning and good afternoon, depending on where your location, to everybody joining us today in our 2016 annual webcast. It's also our first webcast, actually, and our decision to openly disclose and discuss our earnings and overall business, even though we are a private company and have limited shareholders, comes as part of our commitment to keep our debt investors informed and updated with the latest information about our business. And I think we consider it a mission for us to ensure that you are aware of what's happening. Let me move to slide 2 and just to go over the agenda. And I think just to have this one, what I will do is really I will start with a highlight for 2016 financial performance. And after that one, I will have our CFO, Sano, will take you over the other elements, including the revenue trends, profitability, cash flow, and the liquidity of the organization. And then our Senior Vice President, Mr. Ramesh, will jump to discuss the company outlook and the 2017 and the market conditions. Then I will finally conclude this webcast from our side before the Q&A to wrap up, and I think I will have 2 key messages there, one including the sustainabilities, and the other one's our operation excellence, which is our 2 topic very close, dearly to the heart of EQUATE. And then we will be ready to take any of your questions. As you are aware, just to be, for the one maybe not familiar with EQUATE, EQUATE is set up with 4 shareholders, 2 major ones. Dow Chemical have 42.5%, and PIC, which is petrochemical arms of KBC in Kuwait, have 14.5%, and 2 listed private companies in Kuwait, which is both are listed in the stock market. Bobian Petrochemical have 9%, and Glen Petrochemical have 6%. This is just to be aware that's how the setup. As I said, this is for the one which did not join us in the roadshow, so they are aware who are we. Again, the 2016 was the first financial for us, which is combined the whole group together, including EQUATE, TKOC, and of course the acquisition we had for ME Global. So this is 2016 covered the whole group together in this one here. Again, just briefly, I would like to say EQUATE Group did very well during the turbulence 2016. 2016 was a difficult year, and however we feel we are really did our best in this one, and we feel comfortable with the performance based on the market condition itself. As you will see here later on the presentation, we also integrated IMI Global within the group together, and alhamdulillah, this has went very smoothly and we didn't have any business interruption. Also, we sold almost every molecule we produced, and that really give you the strength of our position in this side of it, and really we have sold all our products. And we maintain our strong market share in the EG, in the ethylene glycol side, and we run our asset with almost 100% full asset utilization. That's in all locations, that's including Canada, Kuwait, and Germany. And also, with all this one have done and said, we maintain very high safety performance, and I will mention this one in the closing remark in this presentation. Let's move to slide 3, and just for your follow-up. And again, just before we start getting to dive into the financial result, which is, I'm sure that's your key interest, let me give you just a little bit of a group overview. And as I said, this is also to refresh the ones which was with us in the roadshow, and for the one new, which is they have not joined us in the roadshow. And that's just to make sure that the benefit everybody involved in this call, actually. Again, to tell you that EQUATE Group is a global petrochemical company. Our main product consists of three key products, ethylene glycol, polyethylene, and PET. We have manufactured footprint in Kuwait, Canada, Germany, and hopefully, inshallah, in 2019, we will also include the United States once we complete our world-scale EG facility in Texas. In fact, our total EG production volume will reach 3.2 million tons after the commission of our new EG plant in the U.S. Gulf Coast in 2019. Our diversified global manufacturing footprint that we gained with the competitive supply chain operation, we are mainly servicing our Asian customers, Middle East, Turkey, India, and subcontinent customer from our Shuaibah side in Kuwait. Our PET European customer are served from our Germany facilities, and our facility in North America are serving our customer mainly in North and South America as well as Asia. Moving on to the next slide, and really this is also something just to put in perspective. Maintaining a very strong foothold in key EG market after the acquisition of EMI Global, we are world's second largest EG producers, and really this is where position us very much in there, and we sell product globally covering all the regions. We maintain our strong market leading position in all geographic that we participate in. In 2016, we had 41% in North Asia, and India subcontinent for 19%, Europe 11%, and the American was 24%, and the rest of the world was 5%. Moving on to slide 5 for the financial result highlight, and I will give a brief at this stage, and our CFO will dive into more detail in this one. And as I said, I mean, even the 2016 was a tough year for us, and was not an easy year for the whole petrochemical industry in totally. I would say it was a milestone year for EQUATE internally with our acquisition and integrated effort, and extremely as was navigated low market price without a drop in production. So we sustained our production and we did not reduce any. Internally, as we mentioned several times, we have not lost any our capacities, and we maintain 100% utilization of our Kuwait-based and Canadian-based, and also the German one. In fact, we sold, as I mentioned, every pound of product we produced during 2016. And I think this is, I have to appreciate the team and the leaders in this organization for achieving such seamless integration and high production while maintaining our excellence, safety performance. It really goes to the team working on these assets day in, day out. I have really to say thank you for our people in this organization, in this group, all our assets, in all our businesses, in our marketing, in our all products side of it, really hat off for them, and thank you very much. Externally, maybe it's not in news that 2016 was tough for different markets. The commodity maybe hit the most out of that one, and we worked hard to navigate through a challenging business environment with continued pressure on the price, and we responded by keeping a close eye on our cost through robust cost management, and really we did a tremendous work during 2016 to manage our cost to ensure we consider the environment externally. By maximize our output, as I mentioned earlier, and by keeping our clients satisfied by delivering high quality product with no interruption across the globe. 2016 was indeed a milestone year, and the numbers reported here in this slide, as I mentioned earlier, reflect the combined result. So this is really cover the whole group of EQUATE in total. Looking at revenue, our revenue was down 14%, and really driven mainly by the drop in oil prices that was discussed earlier. This is also a topic that our Senior VP Ramesh will be discussing later on in the webcast. Our operational profit stood at $825 million, 30% less than 2015. Our EBITDA was $1.2 billion. Production volume stood at 4.5 million metric tons, and our consolidated net profit for the years was $679 million. With a very strong financial position, our net debt to EBITDA ending only at 2.5x, and with over $1.8 billion in cash. Now, as I mentioned, we'll dive more in the financial numbers, and I will leave the floor for our CFO, Mr. Fasano, to go over these numbers in detail. Please, Fasano.
Thank you, Mohammed. In the next couple of slides, I will walk you through in more details behind our 2016 financial results. Going through slide number 7, let's have a look at our revenue. As you can see in the slide, we show our revenue both by the region and also by product. It's quite clear that our group is roughly 2/3 ethylene glycol and roughly 1/3 polyethylene, and we pretty much cover all main markets globally. We basically generate about 35% of our sales from Asia region, 20% from Europe, and 15% from Americas, 14% from Indian subcontinent, and then 16% from the rest of the world. I mean, from the revenue by product standpoint, 63% of our revenue is generated from EG, and 23% from polyethylene, and 9% from PET, while the remaining 5%, of course, is from the other products and services. Taking a closer look into our volume and prices in 2016, from an EG side, we are looking at the sales volume of approximately 3.5 million tons at the average price of a little bit over than $660 per metric ton, which was about 16% lower than what we had in 2015. From PE perspective, we sold approximately 736,000 metric tons at the average price slightly above $1,100 per metric ton. Again, 9% lower than the level we had in 2015. And finally, PET volume was 320,000 metric tons at the average price of $961 per metric ton, 9% lower than what we had in the same period last year. In the bottom of the slide, you can see our revenue profile for the last 4 years. While we have been running our plant flat out, and while we have been selling every ton of the product that we produce, the revenue, as you can see, has been trending down since 2013. And again, this is due mainly to a drop in price, which is driven kind of mainly by a decline in global crude oil. Now let's turn to slide number 8. Let's look at our profitability. Despite the drop in prices and therefore our revenue in comparison to 2015, our EBITDA margin was still at a very, very healthy level, exceeding 30%, and this is a true reflection of our low and competitive cost structure. our operational excellence, our high asset utilization, and also, as Mr. Mohammed mentioned, our effective cost management. Group sales dropped in 2016 from 4.1 billion to 3.6 billion, or about 600 million drop, where our EBITDA was dropping only $300 million from 1.5 billion to 1.2 billion. And finally, our net profit was 679 million, which was about 400 million less than what we generated in the previous year as a group. Now, move to slide number 9. Our financial position, you can see, is very, very robust. We end our 2016 financial year with 1.8 billion cash on hand, with our gross debt stood at about 4.75 billion. And that result in a net debt position of slightly lower than 3 billion at the end of 2016. And with our 1.2 billion EBITDA, we end our year with a solid 2.5 turn of net debt to EBITDA. As you all may know, our headline financial policy is to maintain solid investment grade ratings, which translate into an internal guideline that we will strive to maintain our net debt to EBITDA at or below 3x over the cycle. Okay. This financial policy has received full support from the shareholder, and it will basically govern all the other policy, be it the capex policy, M&A policy, as well as dividend policy. Yeah. Total asset of the group stood at 7.8 billion at the end of 2016, compared to 8.3 billion in 2015, and that gives us a pretty solid return on asset of roughly close to 10%, even in a challenging year. Total liabilities stood at 6 billion compared to 6.3 billion in 2015, and that gave us a total equity of 1.8 billion in 2016, with a return on equity of close to 40%, which is extremely high. Now, turning to slide number 10, let's have a look at our cash flow and liquidity position there. Our cash flow from operating activities was at 1.2 billion, and with capex for the year of 164, and the dividend that we paid in March of 2016 of 736 million, we end up with a free cash flow for the year at 286 million positive. In 2016, look at our debt maturity profile. After we have gone through a massive refinancing exercise and put our permanent capital structure in place, we end the year with a very balanced and comfortable debt maturity profile. With a 1 billion undrawn revolving facility on top of it, we do have a very solid financial flexibility. Please note that our last leg of financing plan was complete in February of 2017, when we issued 500 million 7-year sukuk due 2024, the proceeds of which we used to repay the 500 million 2019 bank maturity. So now, if you look at if you take a snapshot, of our maturity profile as of today, we do not have any debt coming due until 2021, which is our 5-year bullet bank loan, and then next maturity will be 2022, which is our 5-year bonds, and followed by 2024, which is our sukuk that we issue in February 2017, and then the last one would be 2026, which is our 10-year bonds. Now, from here, I would like to pass the microphone to Dr. Ramesh for the outlook.
Thank you, Fisno. Good afternoon, good morning, everybody. If we go to slide 12, let's look at the outlook and the price trend that we saw in 2016, compared to history and the early part of 2017. No surprise, we are in a cyclical business, which is the case in most of the business sectors that we participate. But what has clearly been very rewarding is that the supply-demand balance has been very healthy, I guess is the nice way to put it, because bringing EG supply on is not something that anyone can do easily. And of course, the group is very strongly positioned to capture the EG market growth because of our low-cost position and our high profitability level in various parts of the world, because we are a gas-based facility across the globe. Now, if you look at polyethylene, polyethylene also had a pretty good run in 2016. It was a little less volatile, but prices were a little bit on the low side compared to traditional peak profits of polyethylene. But once again, good capacity utilization and the $1,150 to $1,200 a ton pricing was quite steady in the markets that we participate, which, as Fiznu and Mr. Mohammed mentioned earlier, is primarily in Asia and profitable segments in Asia and parts of Europe. So pricing, I would say, despite being volatile, showed clearly a very uptick trend in the second half of 2016, as the chart shows. Turning to slide 13 to give you a quick update on our U.S. Gulf Coast project, which is obviously a significant growth opportunity for EQUATE. The project essentially piggybacks off a capacity utilization agreement of the Dow U.S. Gulf Coast LHC 9 cracker, which is the new one that is coming up that Dow had just announced that is mechanically complete. We have a very competitive supply of ethylene there, and this will further enhance MEGlobal's distribution footprint for glycol, because this appears to be clearly the front runner as the first glycol plant in the U.S. Gulf Coast that will take advantage of the shale gas revolution that has taken place. This plant, upon completion, will increase our production capacity by about 750,000 tons. So overall, the EQUATE, greater EQUATE would be producing around 3.2 million tons when the project is up and running. As you can see from the key dates, progress has been very good. The U.S. Gulf Coast has been a very welcoming area as far as permitting and getting project execution goes. All the long lead equipment order has been completed with approvals from the board, and piling foundation should begin somewhere between third and fourth quarter as we continue to sign contracts with the local vendors. So all things going very well as far as the U.S. Gulf Coast project goes. So with that, let me turn the mic back to Mr. Mohammed Hussain for some final comments.
Thank you, Amish. Again, I think just to make sure that we all there, we are on slide number 15 now, and this is, as I mentioned, we are very proud of our operation excellence and our EITNS matrix, and we are really trying to maintain this high standard and reliabilities, and we try to perform as a high reliable organizations. And this is throughout all the groups, and that's something which will maintain all the times. Our industry is complex in Kuwait, Canada. Our industrial complexes in Kuwait, Canada, and Germany are all considered top class in terms of reliabilities, efficiency, safety, and capability and productivities. We run our plant pretty much flat out again in 2016, which we've been doing through almost our history, with asset mechanical reliability of close to 100%. And that all allow us to maximize our asset utilization, particularly in all of our EG assets, and we achieve all those with excellent EITNS records. Actually, we have achieved almost 40 million consecutive safe working hours without any day away from works. Our recordable injury rate, the RIR, stand at very positive 0.07, which is ranked as the top relative to the global benchmark. If I look at other measures in our EITNS, I think we have 0 process safety incidents, alhamdulillah, and we have 0 LOPC, which is any spills of category 2 or category 3, and we are in full compliance with all environmental regulation. This is just to put things as our operation excellence has remained a critical focus for us, and we'll always maintain that focus in our operation excellence and our safety of the plant and the people and our processes. Let's move on to the slide 16. And in slide 16, again, as I said, we are very much cautious of the requirements globally, and our group has also strengthened its commitment to the sustainability We are adopting the strategy for integrating the United Nations 17 Sustainable Goals, and we are monitoring these goals and trying to really work with them. We are hoping that by 2025 we will have a full integration of these goals through the 3 primary strategic focus area in the environment, in the economy, and in the society. Sustainability will be always a focus, and it's going to continue to be more and more energy will be pushed in that one and the 3 elements I mentioned earlier. Again, I think this is almost conclude our presentation to you today. This is the first for our really history of this company, and we are proud of our history, we are proud of our success, we are proud of our people. And I would like to really pass to the moderator to take care of the Q&A at this stage. Fawaz?
Thank you, gentlemen, for that detailed overview. We will now be starting our Q&A session. Please give me a moment just to go through the questions. As you can see, about 10 questions. Give me a second. Let me prioritize them, group them in the interest of everyone's time, and I will come back to you in maybe 10 or 15 seconds. Thank you for holding. We will now be taking on your questions. We're going to start with the first question we have is from Alexander from Panmure in the UK. And Alexander's question is, why did the company pay such a large dividend in 2016?
Again, I mean, you have to understand we are a private company, and with our cash present, as you've seen it, we've been always committed to ensure that we meet the ratio which is we have committed to debt to EBITDA to 3x, and based on the cash availabilities, I think we have been doing this one to commitment to our shareholders.
Thank you. We have a question from Elizabeth Williams from JP Morgan in the UK. The question is, could you please comment on drivers of the EBITDA margin compression in 2016? And many thanks in advance. I believe that question is going to be answered by the CFO.
Okay, I think mainly the drive for the compression in the EBITDA margin is even mainly by price. I think you've seen the price trend first half of 2016 in particular, or following on the late 2015, oil price was at the low. I think that was the main drive for the low EBITDA in 2016.
Thanks. Our next question. Let me see, which one am I going to take? Yeah, the next question is going to be from Pratik from Goldman Sachs Asset Management. The question is, how is the 2016 EBITDA of 1.176 billion being calculated, which we displayed in slide 10? He continues that he thinks the earnings release had an EBITDA of 0.824 billion for 2016, and he's requesting clarification on the EBITDA.
Okay, I think there could be some confusion here, because the EBITDA 1176 that we report in this presentation is basically a combined result, combined EBITDA, which include TKOC, EQUATE, as well as ME Global. If I may guess that the number of 824 that was referring to in this slide was referred to the announcement that we made in March 30th of 2017, and that was for EQUATE standalone without combining TKOC in that number.
Thanks. That answers that question. Next question is from Simreen Sandhu from Standard Chartered. The question is, can you please provide some CapEx guidance for 2017 in terms of maintenance CapEx, and also how much do you need to spend for the US project in 2017-18?
Okay. Well, our CapEx plan in 2017 is approximately 850 million, consisting mainly of the CapEx spending for our US Gulf Coast project, which is going to be about 600 million, plus the turnaround CapEx at our Kuwait site, which is going to be around 100 to 150 million, plus the normal regular maintenance CapEx for the group, roughly 50 to 70 million in that range.
Thanks. And while on CapEx, Pratik from Goldman is also asking what is your guidance on CapEx, which I think you just delivered. But he also continues to ask if ethylene glycol and polyethylene prices stay at spot levels, how much EBITDA do you expect to generate?
Well, I guess it is our policy that we do not provide a future forecast or forward-looking statement on our financial result, but you can refer to 2016 as a guidance. Yeah.
Thank you. We have several questions from Pratik from Goldman. We have three actually. So we're going to take them one by one. The first question is, can you share some data on the volumes for the ethylene glycol and polyethylene business for H1 and H2 2016? Now before Mr. Ramesh answers, I believe this was already covered in the presentation on slide, just give me a second. So I just want to guide Pratik to slide 7, where we've also discussed volumes for EGMPA. However, Mr. Ramesh will also be going to be answering this question.
Yeah, sure. I think it's specifically, I think there is, it's a very good catch by Pratik, I guess, who has obviously analyzed our data pretty closely, so my compliments there on the difference between the first half and the second half. Yeah, second half, there were quite a few tailwinds for us, in addition to price, of course. Price was a major booster to the EBITDA being higher. Volume was a very big help because the plants performed exceptionally well in the second half of the year. Glycol volume was ahead by almost 100,000 tons. And polyethylene volume, because of the feed and some other product mix issues, was up by about 80 to 100,000 tons also. So volume helped. Cost obviously was another big driver. If you look at gas prices and where operating costs or fixed cost advantage, code reds and stuff like that on cost control at EQUATE was enormously successful in the second half of the year. So if you combine volume, variable cost reduction because of gas prices going down, which is what we are based on, and then our cost reduction efforts, I would say all of them contributed to the second half being a whole lot better than than the first half.
Thank you for that answer. Pratik's second question is, and I will read it as is. He says, we see that the implied cash OPEX for the ethylene glycol business, reported revenues of EBITDA, was 35% higher in the second half as compared to the first half of 2016. Was this driven by, given this seems to be a steep jump considering the fact that revenues were only up 7% from H1 to H2 2016?
Yeah, that's what I was pointing out. It is, it's a combination of revenue, of course, but cost reductions was equally important in how things helped.
Thanks. We have a question from Elizabeth. She's following up on her earlier question. And she's asking, would it be possible to clarify the trend in EBITDA margin rather than notional?
Well, what I can refer to is that if you look at our presentation slide during our roadshow, first half EBITDA margin was at about 31%. Okay, and if you're looking at the combined 2016, it's about 33%. So obviously, trend-wise, second half 2016 is much more profitable than first half 2016. But if you were to look back into 2015, 2014, I think it was under the very, very high oil price scenario, and therefore the margin is much a little bit higher than the level we have seen in 2016.
Excellent. And with that, we've come to answer all the questions that were sent to us. I see no questions coming in at this moment. However, we'll give you 30 seconds. If anyone has a question lingering in his mind and wants to ask it, please shoot it right away. Otherwise, we will be concluding. And I see one already came in. The question is from Mustafa from Saturna in Malaysia. From Saturna Asset Management, I apologize. The question reads, could you please provide further information on the use of sukuk proceeds? Do you have specific use for that Sharia-compliant debt that was raised?
I think the response to that question is pretty obvious in the presentation. Basically, the proceed that we use for sukuk that we repaid the 2019 bank loan, 500 million.
And he has a follow-up question: can you provide some information on your sukuk strategy?
Well, at this stage, we are not intending to attend any of the capital market this one, but definitely we have all the venues open for us in the future.
Thank you very much, gentlemen. I'd also like to thank our audience for sending all those questions and for attending today's call, as we will now be concluding this webcast. Should you want to revisit this webcast and access a live and unedited recording of this session, it will be available in about 2 hours on the same link you used to access this call. We look forward to seeing you again, and we wish you a good day.